All right. So let's go ahead and get started on this webinar. We're going to be talking about the IRR, the internal rate of return. And oddly enough, this is one of the highest registered webinars we've had in a while. And I think it's because there's a lot of, confusion around what really is that internal rate of return, that IRR that we see so often when we're reviewing some of these multifamily offerings, but also when you're putting these deals together for yourself. How can you better explain that to your investors at the same time? So before I get started, let me tell you a little bit about myself. I am a managing partner with a group called PassiveInvesting.com, like you can see right here on your screen. And you can click on, when you go to PassiveInvesting.com, for those of you who are joining us live, I'll go ahead and type that into the chat box for you. When you go to this website, there's a little place here that says Meet the Team. So you can click on Meet the Team and you can see our team that is listed here. And then you can click on my name, Dan Handford, and you can find out more about me. So I'm married, have 4 children, all under 10 right now. Next month, I'll have our very first double-digit child, so she'll be 10 years old. But we have a 9-year-old girl, 8-year-old boy, and a 4-year-old and a 2-year-old girl. So life is very busy here. And then I live and I work right here in Columbia, South Carolina. So not too far away from a lot of the assets that we're actually acquiring right now. And we actually do have 2 things I wanted to mention to you just briefly before we get started. We do have a current offering. So if you go to our website, you can click on this little current offering button and you will see there is a landing page here. For those of you, again, who are joining live, I'll type this in here for you into the chat box. If you want to have a direct link to that, you can. This is one of our current offerings. I'm not going to go into a lot of detail with this. You can review some of the video and some of the information here. This is open for accredited investors only. So if you are an accredited investor and you want some more information about this particular opportunity, then you can go to this website here, click on the current offering, or click on the link right in the chat box there, and then fill in your information here to request access to this detail information, and that way you can review this deal further. The second thing I wanted to mention to you is we actually have a different fund that we've created now called the PIC Fund. I don't know if you can see that very well. It's called the PIC Fund, the Passive Investor Club Fund, and this fund is a short-term or it's a short-term private lending fund, and we provide 6-month short-term loans to rehabbers, fix and flippers, things like that through this fund. It has a 6% preferred return. It is open to accredited investors only as well. And so if you want some more information about that, you will have to email me because I don't have a link to that one right now. We're working on a little landing page for that, but right now we don't. So you can go to you can email me at dan@passiveinvesting.com, and we'll be glad to provide some more information to you on that. The nice thing about this fund is that it has a 90-day liquidity option. So instead of just sticking money inside of a savings account or money market that's earning you probably 0.01% right now, you can place it inside of this fund with a 90-day liquidity option to it. So if you need access to that cash, you can pull it out, and you have we have 90 days to give that back from in that particular fund. So if you want more information about that, you can do that there. The last thing I wanted to mention to you is this is my LinkedIn page. For those of you who are joining us live, feel free to click on the link there and connect with me on LinkedIn. I do try to share some content and some articles and posts and things like that around multifamily on my LinkedIn page. So go to that LinkedIn profile and connect with me, and I'd be glad to connect with you as well. Then the last thing I wanted to mention, or the last 2 things, I guess, is about our Facebook page. So a lot of you have questions I don't always get to. So if you want, you can go to the Facebook group and post some of your questions there, and we'd be glad to do that at the same time. There we go. So you can click on that link there. You do have to ask a few questions and apply to be a part of this Facebook group. But as long as you answer the questions properly, then of course you'll get access to this group. We have almost 7,000 members as a part of this group. So it'd be really a good opportunity for you to be able to connect with some other like-minded multifamily individuals. And then this is our YouTube channel. So a lot of you have gone here and just have subscribed to it. So we post every single week. We post videos on here, and we're actually getting ready to ramp this up a little bit because we're in the process of building out a video recording studio. That'll be our own in-house studio. And I'm thinking that'll probably be done by, probably November, December. And then starting first of the year, we're going to start to be able to ramp up a lot more videos that we'll be able to provide you as far as content around multifamily. So make sure you go there, click on this little subscribe button. That way you're notified of future videos that we post on there. All right. So let's go ahead and dive into this, understanding the internal rate of return. And it's actually a fairly simple calculation, and not a calculation, but it's a very simple concept. So let me first do this. So on the screen here, you see these questions I'm going to go over, and that's usually how I'll do it. But today I do have a little bit of a visual that I wanted to show you just so you can kind of see what this actually looks like, this calculation. So I'm going to try to zoom in a little bit on this thing so you can see a little bit better. I'm going to change my share button here so you can actually see this. So this I'm just going to show you the calculation first, and we're going to describe a few things about it so you can understand it. So here's how you calculate it, is this by this formula right here. And as you can see, it's a fairly complex formula, and you typically will not be doing this writing this out by hand. And so what you'll want to do is you'll actually want to calculate this either by, you can actually Google IRR calculator, and it'll actually pull up a calculator, and you can put all the different information, all the details in there to figure out what your internal rate of return would be. But then you can also use Excel. So Excel actually has a function called the IRR function, and you can put in the details and information inside of the Excel spreadsheet, and it'll calculate this so you're not having to do this by hand. If you if you don't like the way this one looks, this is a different way to actually show it, is to make it look like this. So let me zoom this one in just a tad, a little bit too much. So here's another way to kind of see what this one looks like. There we go. So this one is, if you are more familiar with the symbol there on the left, I can't remember what that symbol's called. It just slips my mind right now, but this is the formula. And so most of you are probably looking at this going, okay, Dan, that did not help me very much, right? I don't really understand still how to calculate the IRR. And what you really need to understand as a passive investor is you need to understand, no, yes, you are correct. That's the net present value on the left there, but I'm talking about that little E. It's like, I think it's called the sigma or something like that, sigma symbol. But anyway, so what you have to really understand as a passive investor, but also as a syndicator putting together your own projects, you have to be able to understand what the IRR is, right? Not necessarily always the exact ways how it's calculated, because it is a complex formula, right? But let me actually do this. So we're going to go back to this page here. So let's first kind of talk about what's the difference between the IRR and the ROI, right? Because we a lot of times think about the ROI when we're thinking about an investment, because that's that return on investment, right? So you put money in, you pull money out. What was that return for that that amount of money that you invested in that project? So I'm gonna do a quick quiz with you guys real quick on here for those of you who are joining us live. So go ahead and get ready, get your chat box ready, and I'm gonna ask you a question here, and I want you to give me your best answer on here. So here's a scenario I want to give you. Okay. So if I were to tell you that I invested $100,000 inside of an investment and I got $300,000 back, is that a good investment? Go ahead and answer that right now. Just say yes, no, whatever. Do you think that is a good investment? I put 100,000 in, I got 300,000 back, right? All right, so yes, I'm getting a bunch of yeses, yes. I got some people that are starting to think about this a little bit, because they're going, wait a minute. What about the time frame, right? There's several of you on here like, well, depends. What about the time frame? How long did it take? And that is the critical that's the critical piece that you have to think about when you're thinking about a return. Even though you look at a return on investment and say, oh, I got a 100% return or a 200% return, but how long did it take you to get that? But because what I didn't tell you is that it took me 30 years to go from 100,000 to 300,000. So now the question is it a good investment? So now that I've given you that other factor, is that a good investment? And so a lot of you that were asking, well, what about the time? The time, that really is a key component, a key factor is understanding the time component. And the ROI does not bake into the time component factor. And so the IRR actually has a time component to it. So it gives you an ability to kind of have a true picture as to what your actual return is going to be. And that's that internal rate of return. Now, some of you might be thinking, well, what does that mean for me, right? How can I properly, compare investments? The best way to compare these investments is not by the annualized return and not by the ROI or the percentage return. It's always on that internal rate of return. So typically in most offerings, we'll usually try to highlight the annualized return because most people are more familiar with that. But when you're trying to compare one investment to another, looking at that IRR is really the better way to look at it, right? And so as a syndicator putting deals together, how are you going to be able to increase the overall IRR? Now, as a passive investor, you have very little control over that because you are basically putting that money in. You don't have any decision-making power of when you're going to be able to get that money back. So if you think about this, that the IRR is actually a negative number until what point? At what point is that IRR a zero? Is it a zero IRR? And at what point is it a positive IRR? Does anybody know? So type it in there if you know. At what point is the IRR not a negative number? Because the moment you put money into an investment, you actually have a negative IRR. Matter of fact, you have a negative 100% IRR almost, right? So what would that be? So it says there's several of you in here answering this. So when you sell the deal, the first positive cash flow, break even after 1 year, at time of cash return till the initial capital is returned, bingo. So that is actually the answer to the question. Is what Mr. Patel here, Benny Patel, is saying is it is actually until all of the initial capital is returned. So if you put $100,000 into a deal, you're going to have a negative IRR until all of that initial capital that you invested has been returned to you. And now you have a zero IRR. And then any amount of money that you get after that starts to increase that IRR. But the longer you hold on to somebody's capital, the lower the IRR is going to be. So the opposite of that would be the faster that you can return that money back to an investor, the higher the IRR is going to go. So it's one of the reasons why we like to do monthly distributions. So instead of doing quarterly, we're actually doing monthly distributions. So it's not a major jump in the IRR, but it gives a little bit of a jump in that internal rate of return because we're able to return that money back to investors faster, right? It's the same reason why if you have a deal that's going to be held for 5 years or 7 years, if you can sell that deal a little bit sooner, then you can achieve those IRRs a little bit faster because you're returning that initial capital and giving returns faster than just holding on to that capital as long, for the entire hold period. Okay. Now, we kind of already answered this next question, how does the IRR compare to the AAR, that annualized, the average annualized return? So typically you'll see that average annualized return and you'll see an IRR, the internal rate of return there. And they're different in the fact that just like the IRR and the ROI does not bake into it the amount of time. The AAR does, but it doesn't take into account the different points along the interval that you're actually receiving that money back. It basically just says, okay, you put in 100,000, the whole life of the deal, you got, 200,000. So you got an X amount of annualized, depending on how long you held it, right? So if you were to, that would be more like a 20% annualized return. If you put 100,000 in, got 200,000 out on a 5-year hold, right? You would have a 20% annualized return, right? Now, if it was exactly like that each time throughout the process, the IRR would be very similar to that as well. But it's the AAR basically just takes the total aggregate amount and then divides it by the number of years or months that you actually had the money tied up, right? The IRR takes into a little bit more of a specific account to how fast you're getting it back. And where this would be really important would be when you have a deal that, say, is a lower end property or a new development property and they're doing a lot of renovations or building the property from the ground up, and your money's tied up for the first year, 2 years, sometimes 3 years before you get any return. Well, they might sell it, right? So you don't really have the ability to kind of see, you don't have any returns that are coming in month over month or year over year. You're just getting this kind of lump payment at the end. That average annual return will tell you how much money you actually, or your annual average return that you had year over year, versus the IRR will take into account you put the money in, you had to wait 3 years, and then you got your money back, and so it's going to have a little bit of a different time component value there. So there's going to be usually the average annualized return will show a little bit higher because it doesn't take into account a lot of that, and then the IRR will usually be a little bit lower from that standpoint. Now, when you look at the IRR, it is not a number that you look at from a total isolation standpoint when you're looking at a deal. It's to see how good the deal is, right? There's so many other things that you have to look at. You have to look at the market selection, the operator selection, the asset selection, the asset location in that market in that particular selected market. And you have to look at how the deal was actually underwritten. What are some of the sensitivities that have been done on it? Are there contingencies in there? Is there plenty of operating reserves in there? What's the expense ratio? What's the break-even occupancy? And you have to look at a lot of these different numbers to really have a full understanding and grasp on your investment and where you're putting your money, right? And so that's one of the things that I do is I look at the IRR and I look at the average annualized return. I look at the equity multiple, but then I look deeper, right? I want to go deeper and kind of see what are some of those underlying characteristics of the deal that could either make or break that deal. So let me go ahead and open it up right now and see if you have any questions, and I'll answer some of those questions. I know there's several of you have already submitted some questions in here, so I'll kind of go through here and kind of see what questions that might have been through here. For those of you who have kind of joined us a little bit later, we do have this recorded, and we will send out that recording later, probably this afternoon or tomorrow. Usually Melissa's Johnny on the spot, if you will, or I guess Melissa on the spot, and gets these out pretty quickly. So if there's not any, here's one question here. How does the IRR compare to the equity multiple? Well, the equity multiple is really just taking into account how much money you put in and how much money you pulled out and what the multiple is on that. So it's not a percentage at all. So if you put 100,000 in, you've got 200,000 out, you got a 2x multiple, meaning if there's a 2x if there's a projection of a 2x multiple, whatever amount of money you put in, you just multiply by 2, and that's how much your projected return would be. So if they're projecting, 1.86 x multiple, right? Then you can take your investment amount, just say 100,000, multiply it by 1.86, and the full life of the deal goes through, you're going to get 186,000. Now that'll include that 186,000 includes that initial capital. So you would have made, as far as a return, 86,000 on whatever that time frame was for that particular investment. Let's see. Historically, during a recession, how does the projected IRR hold up? What are the factors and variables? So historically, during a recession, obviously what's going to happen is that IRR is going to drop a little bit, right? Because if you're in a recession, sometimes or chances are you're going to probably withhold some of the cash flows to be able to, make sure you don't have to have a capital call in the future. So you might be stopping distributions for a period of time. And if you stop distributions for a period of time, it will actually cause that IRR to go down because you're not giving back. Because remember, the faster you give money back to an investor, the lower that IRR is going to be. And Sebastian's asking, are you showing any slides? No, I'm not showing any slides. We're just having this conversation. Showed a few things earlier on in the presentation, but I mostly just have a conversation around what we're doing here. So, all right, when making an offering, how do you identify the minimum acceptable IRR? So it's kind of hard. And I'll give you some of our kind of general, ranges that we like to see at our group, passiveinvesting.com. And you really have to understand your investors to really understand what's their tolerances, right? And so, and then of course, different positions, in the market and different markets might be a little bit different as far as those returns are concerned. But as far as the internal rate of return is concerned, we only go after two different types of assets: a B+ asset with value add, or an A class, kind of a suburban class A, we call it an affordable class A because they're not urban downtown like $7,000-8,000 a month. They're usually between about $1,300 to $1,700 a month, somewhere around in there. So it's we call it a suburban affordable class A. And if we're going after a B class, a B+ with value add, we're going to typically want to have that IRR anywhere between about 13, 14 on the low end, upwards to about 16, 17, somewhere around in there. Sometimes higher. I mean, if we can get a little bit higher, that's great. But a lot of times, especially right now with COVID-19, we initially underwrite with our pre-COVID metrics, and then we have to bake into some of the underwriting, some of the differences, or not the differences, but some risk mitigation factors, if you will. So I'll give you a quick example about a few of those. I know a few of you are already asking about some of those, what things that you can do in your underwriting to kind of mitigate that. So typically when we underwrite, most of our underwriting that we do, we'll usually have a 7% vacancy during our renovation period. Well, on this latest offering that we have, we actually did it on a we did it at a 9% vacancy during our renovation period. And so we don't think it's going to get to that point, but because this property that we're acquiring is historically had 95%, 96, 97% occupancy. And so for it to go down to 91% would be, fairly uncommon, but we underwrote it for 91% just in case, because right now there's unknowns as to what might potentially happen. I think anything that might happen from COVID will be short-term, short-lived. And obviously we're holding on to this property for a 5-year time frame. So we'll be able to withstand some of those pressures. And then this particular property we're only renovating about 50% of the units. And so typically with only renovating 50% of the units, and the reason why we're only doing 50% is because the other 50% are already have been renovated, and the business plan of the model has already been proven for us. And so we're taking over that business plan. But when you are, we would typically on those 50% probably be able to renovate those in about 8 to 9 months, 10 months, somewhere around there. We don't underwrite for that. Typically we'll underwrite for like 12 months, but in this particular deal, we expanded that even further to 20 months. We expanded it to 20 months to be able to help mitigate some of that downside risk. And so it's kind of hard to really know for sure what your investors would accept for a minimum acceptable IRR. But with our group, we would always rather under project and then over deliver, right? So instead of because if you know anything about underwriting, you can make the numbers look really good if you want to, but I also want to be realistic with my investors. I don't want to always be known as the group that over projects and just shoots right under it, right? I would rather project right under it and then overshoot every time, so I can be known as someone who actually outperforms what my original projections were. So even if I actually was sitting down talking with an investor yesterday when I was on a trip, and I talked to him about, how if I projected that you're going to get a 17% IRR, but then I only give you a 15% IRR, then you're going to look at me and go, man, he didn't hit his targets. He didn't hit his projections, right? But if I do it the opposite and I tell you I'm going to get you a 15% IRR, but then I hit a 17% IRR, then I like hung the moon, right? Because, we actually over projected. We actually over achieved the actual original projections that we put out in front of the investors when we were going out with the project. Good question there. Got a couple other questions here. Got time for maybe one or two more. Let's see here. What is more important, the project level IRR or the LP IRR? So, well, that depends on which side of the table you're on, right? So I would say from a passive investor's perspective, it's going to be the LP IRR. And so for those of you who don't know what we're talking about, so usually there is like an overall IRR for the entire project that is just basically what they call a project level IRR. And then that takes into account both the GP side and the LP side together. And then when you look at just the LP side, that's the one that for you as a passive investor, you would want to focus on is really that LP, that limited partner IRR. Let's see. At what point would a high IRR become a red flag on a deal? For example, a 25% IRR, if the IRR is too low, does it automatically mean it is not a good investment? So I think you have to look at things a little bit close. Obviously, if you're getting into a deal that's like sub 10% IRR, then of course it might not necessarily be a bad deal. They might just be very, very conservative in their underwriting, or they might not really, it might be a different business plan, right? There's different business plans and with different asset classes and things like that, because you're not going to do the same kind of a business plan with a value add deal as you will with a core plus or a core property, where you're just going to kind of hold on to it for cash flow. So there's several different factors that come there. And as far as a high IRR, one of the things that we like to do on our projects is we will give a range of IRR based on exit assumptions, right? And so some of our projects might show, depending on where we exit, a pretty high IRR, but it's going to be because we're in that sensitivity analysis. That means that we're going to be exiting at a lower cap rate than when we purchased, right? Now that's just in our sensitivity analysis that you can actually see some of those exit assumptions. So if we were able to exit a lower IRR, a lower cap rate, then we can have this higher IRR upon exit. But being realistic, it's going to be probably somewhere in the middle there between that high end and that low end, where you're expanding or contracting that particular exit cap rate assumption. All right, I'll take one more question. I know several of you have a lot more questions in here. I apologize for not being able to get them to you today, but make sure that you go to our closed Facebook group. I mentioned that earlier on. You can go to our closed Facebook group and just fill out a few questions there, and then also subscribe to our YouTube channel. But if you go to our closed Facebook group, you can be a part of the community there and ask some questions, maybe connect with some other multifamily investors, and then we can kind of go from there. All right, let me see here. For deals that you sponsor, what is your targeted IRR? Kind of already went over that. I came in earlier on. Same thing with the next question. Let's see. What threshold of units or deal size do you think it's better to use private equity instead of a private loan? A private loan doesn't necessarily consider IRR since it's just interest and no equity. You'd be surprised because even though it's just interest on a debt side of things, so it's a private loan, they're still looking at that IRR. It's just going to be a lot lower because they're in the bottom of the capital stack, right? And so being at the bottom of the capital stack is a lower risk position, right? And so if you're in the lower risk position, then that's going to allow you to have lower returns. But in our situation, we don't syndicate or we don't bring in private investors for the debt portion, right? We are only raising for the equity and ownership portion inside of our assets. And so depending on your business plan and things like that, I've seen some people do that where if it's kind of a smaller project or whatever, they'll raise the debt on it. But those investors are not going to get as good of a return unless they were on the equity side, right? So what we typically do is we'll typically get, 65 to 70, 75% loan to value loans from Fannie Mae, Freddie Mac, or maybe even some bridge lenders. Not lately with bridge lenders because the interest rate's a little too high right now, but with Fannie Mae and Freddie Mac, the agency lenders, and we get then we'll syndicate the down payment and closing costs and fees and things like that on top of that. So there's a couple of things to kind of think about and look at that when it comes to the differences between getting debt versus the equity on a particular deal as well. All right, so I don't have any further questions I'm going to be able to answer today because I do have a hard stop here at the bottom of the hour. Thank each one of you for being here. Let me see if the webinar is updated for next week. Nope, not yet. Let me see here if I can pause this for just a moment. There we go. There we go. Here is the new topic for next week. It is, do you want to be a mom and pop apartment investor? And so we're going to cover this topic next week. And so if you are interested in this, we're going to talk about what is a mom and pop operator, the pros and cons of acquiring smaller properties, what are typical returns for mom and pop style assets, and is it better to passively invest in large syndications? So here's the link for those of you who are joining us live to be able to join us next week. It's going to be on Tuesday next week. So make sure you mark your calendar for that. Tuesday next week at 3 p.m. Eastern Standard Time next week. And looking forward to diving into this topic. And again, for those of you who are kind of joined us a little bit late, if you want to have some more information about that project that I was mentioning earlier on, you can certainly go to our website, passiveinvesting.com, or you can also click on this link here to find out more information in regards to the Braxton Cary Weston project. So hope you guys have a good rest of your day. We'll see you back here next week.